We just had actually a question come up this week about what happens if the builder walks away. How does that work in terms of your lending, and how does CMHC in terms of insurance or how the builder is bonded? How is their protection?
So I would like a little more backstory there. We've discussed already. There's two types of lending, right? So maybe we can elaborate what would happen in kind of both situations where if it's a construction draw loan, what would happen if the builder basically shit the bed or walked away in the middle of the deal, or what happens if it was just a mortgage at the end and the builder shit the bed or walked away at the end of the deal and you never actually got the property? What kind of happens? What protections exist, if any?
So, my background is originally on like the insolvency and restructuring side of things, so I've seen a lot. I'll start with the easier one. So, in the case of where we don't have a construction loan, but you have a property that you're buying off of a developer, and the buyer does not end up delivering the unit, you do have recourse against the buyer. You do have recourse for your deposit. You would be suing them. You'd be hiring a lawyer and going after the builder, after the company, to get that back. The more complex cases come in when we're doing construction loans, and you have a builder that either files for bankruptcy or is insolvent, or just the business fails midway through the project, and a whole host of things can kind of happen. So I'm going to back it up a little bit just so we can kind of understand through an example, what happens if these things can kind of arise. So, generally speaking, you're either building something for yourself as a developer, or you're hiring some third-party general contractor. And in the case of a third party, that GC might have 6 or 7 or 8 other projects. And they're collecting, they're getting paid as they go. They do perform a certain amount of work. They send an invoice to their customer. They collect a pile of money, and so on and so they go. Now, all that money is going into one bank account. In an ideal world, you'd have a bank account for every single job, but no one actually does that, and it's not very practical. So you have all this money from all these different jobs that are being commingled in this one account. And meanwhile, I got one customer that's slow to pay me, and I got another one that's on time. But all the while, I've hired all these sub-trades, my flooring guy, my electrical guy, my plumbing guy. They all got to get paid for their jobs. But if I got one guy that's not paying me on time, well, that's a domino effect because I got to pay everybody else out. Now, what ends up happening is if that issue kind of goes on for too long, that can kind of snowball a bit out of control. And the bad thing that happens is either A, the developer ends up running out of money, or B, you have some trades that don't get paid for a period of time. And what they have the right to do is, if after a certain amount of time that they've done work or left supplies on site and they don't get paid, they can file a lien on the property, which is the equivalent of like a mortgage charge almost. That's when the music stops. Once there's a lien that's filed on the property, no construction lender is going to be able to advance further funds until that gets rectified. So everything basically comes to a grinding halt. So that would probably scare the bejesus out of most borrowers because you don't want to have that happen. That's a big issue. So for that reason, most construction lenders and CMHC is now requiring this on the majority of their files. I'd say 9 out of 10. They require something called bonding, which is a type of insurance that comes into play during construction. And there are different insurers that will offer it. You can go to Trisura, you can go to Lloyd's of London. Different people will offer it, and it's really there to provide two types of protection to both the borrower as well as the lender. On the one hand, you're going to have a performance bond, and that's really there to make sure that in the event that your general contractor fails or is insolvent or can't continue the work, that insurer is going to find another GC or another party to finish that off at their expense. So that headache of how do I find a backup, how do I do this, you've now shifted that risk onto your insurer. You pay them your premium, they take after that side of things. So that part of the problem is now solved. But we saw these trades here, and they didn't get paid. And fact of the matter is, they're probably not going to do any more work until they get paid. So the other coverage that they'll offer you for bonding is for labor and materials. And most cases, you're generally funding, 50% of your hard. You're never getting coverage for 50% of your hard costs because in most cases, the problems don't happen in the first little bit of the project. They happen kind of once you're in and around the 50% mark and onward. So that type of coverage would step in to make sure that all of your subs are getting paid and back onto finishing the job, and it'll help clear up any liens that may have been registered. And those two things together, once you have that kind of coverage, in the event that these unforeseen issues come up with either some of the trades or even with the GC, this insurance coverage or this bonding coverage provides security to both the lender and the borrower, for any of these unforeseen issues that may arise. And sometimes life happens.
So that almost seems like it basically makes it have no risk. It's like, is it as easy as it sounds like you make it on paper, or are there caveats or issues around bonding? Or does it basically mean if you can do everything right, your contractor screws up and you're safe because you're bonded?
Yeah, no. Once you do have your bonding in place, that's a fair way to look at it. I mean, granted, like I said, we in most cases CMHC is only requiring bonding coverage for 50% of your hard costs. So so keep in mind of when it actually does kick in. But yeah, that'd be a fair comment to make. The only area where a hiccup might come up is whether or not your GC is someone who would be approved by a bonding company.
So that was going to be my next question. Just like I assume, teenage drivers pay more than 50-year-old women when they get a car for insurance, does that mean that if your contractor is bondable, that's a good sign?
Yes, I would say that would be one of the first questions I'd be asking a GC in a meeting, if they had gotten approved for bonding before and with whom, because that way you'll at least know that that you're not reinventing the wheel in this one. Someone's actually gone through this moment.
And on that point, because I love to dig into this stuff, is it more like if they've never done bonding before, is it hard for them to get, or is it more like if they've had a problem before, they can't get it again?
I wouldn't say if they've never had bonding before, it's a problem to get. It just might be a longer process to put in place. So if you have the time in your project to kind of account for that, then by all means you can go forward. But no, it's really just more of a timing side of things. If you've had issues in the past, or quality issues, a lot of warranty claims with things like Tarion, for example, those would obviously be big black marks on your application. But it's not an impossible thing. The places where people would probably have a harder time is if you only have 1-2 years experience, newer to the trades, haven't been doing this for a long time.
Who is paying for
The borrower.
borrow? Is that expensive?
It depends on what the loan size is, and it depends, what the area that it's in. So a more remote area might be a little bit more expensive than if you're in a major center, and it's generally based on the size of the project.
And to clarify, the borrower's paying for it, but that would be part of the construction project.
Yeah,
Same as
that's
the
right.
other line.
Yeah, it would be no different than the general liability insurance that have on the site.
And does the bonding cost vary also, not just on the size of the project, but the type of construction as well?
Yeah.
Because I assume building townhouses that are up in 10 months is way less risky than a 50-story high-rise in a downtown of the city.
Of course.
Right.
Yeah. No, it's project dependent. It's the strength of the GC. Obviously, if you're hiring Ella's Dawn, you're going to have a bit of a different ride than if you're hiring Joe's Contracting.
So then it sounds like because CMHC requires bonding the majority, I remember back in the day they didn't care as much. Now they want more bonding in place. I'm guessing they did that because more and more smaller buyers and borrowers were getting into this game and they were trying to protect everyone a little bit.
Yeah.
But then it sounds like that a lot of the potential risks of draw construction loans are kind of just completely mitigated for the most part.
Yeah, by and large, like once you have that bonding in place, you do take away a lot of the headaches that can come with a construction file. Primarily being, having to worry about the financial wherewithal of the GC, and whether or not, they're doing what they should be with the subs. Now, make no mistake, in the event that you do need to make your claim for bond, and it's, without a doubt going to cause a disruption to the process. But, you're taking something that, you would have had to litigate and could take months in court, and, truncating that down to, weeks and months to kind of have to go through with it. It's still that you're filing an insurance claim, so it's going through a bit of a similar process as you would there. Not totally the same for like your home and auto insurance, but you do need to file proof and show that that there were damages had and that the claim is valid, and someone on the insurance side is going to need to review and adjudicate that. But generally speaking, they are taking that risk of things off the table.